Sweet. Take it away.
Yeah. I just want to start with why this is even an important conversation. So I think one of the biggest challenges in today's world is specifically for real estate is that clients, they read headlines, right? And those headlines don't really tell the full story, or they tell an incorrect story. They're really engineered for clicks. And so I think it's so important for the agent, right, to be understanding of what's happening in the market and be able to communicate the data. So the data is what matters, and we need to be able to articulate what does the data actually mean to the buyer, to the seller, to the investor, that helps them to make educated decisions in this market.
Yeah, we have to become a lot better of a thought leader. And we've seen a lot better movement inside of Keller Williams just on social media, putting out press releases. Like, you have to be the named source of real estate in people's brains, specifically your sphere of influence. So you understanding this, I know taxes, accounting, and market statistics is usually where people fall asleep. So stay energized, stay through, hanging in there with us, because I'll tell you, learning and internalizing this data and making it hyper local as you reference these state and nationally is very important. And this is live. You can download this and connect, put these in your presentations, that type of stuff. So we're going to do a great recap. I've been to family reunion for 16, 17 straight years. And one of my favorite pieces always is the vision speech. That's where Gary, our research department, Jay Papazan, Ruben, they go through and compile all of the market data and present it to us in a very relevant way. And I'll tell you, probably this is one of my favorite ones in the last 7, 8 years. So a lot of relevant data. This usually goes 2-3 hours. We're not going to have enough time, so we'll go as fast as we can, but grab these slides, go through them on your own, and we'll try to summarize as much as we can on this recap. So.
Yeah. The actual recording too with Gary and Jay, it's live in Connect, so you can log in and watch the recording. So if we miss some slides or skip some just for time's sake, you can go back and watch the full recap. And really, we're going to go through the numbers that drive the U.S. market. One thing, Johnny, that you do every quarter is you break down what's happening in Utah specifically. And I don't know what Gordon's up to, 160-ish slides, something like that, around data specific to Utah. And so I know we're ending Q1. You do that once a quarter. So that's probably coming up in May, would be another thing to put on your calendar.
Yep. Yeah, so we'll jump through the 6 main categories, starting with home sales. And just a little bit of perspective, I'm entering my 20th year in real estate. So I got in right after the boom of the early 2000s. I saw nothing but the Great Recession.
So I've caused it.
I'm the one that caused it. So I've seen the dips, I've seen the ups and downs, and I'll tell you, just as we journey through all these, the theme that was coming out of the vision speech the most was perspective. And as you go through these, I'll tell you, the perspective of where we're at as a real estate and an industry, a real estate economy, is a very good spot to be. Had we not had some low rates of 3% and 3.5% that kind of skewed our perspective coming out of COVID, it would kind of put a little bit more in reality of just how healthy our real estate market is right now, kind of being a pretty traditionally balanced market. So if you look at home sales, again, we've kind of flatlined the last 3 years. If you look at 2023, 2024, as soon as those rates start going up towards the end of 2022, we just kind of start seeing that reduction of closed units. We've averaged in the country 4.2 or 4.1, 4.1, 4.1. We thought we'd see a little bit of a pop towards the end of last year. Rates were a little stickier than we wanted, and we ended the year at 4.1. We are projecting 4.3. So anywhere from a 5 to 10% increase in closed sales. I think had we not had some of the turmoil even the last 2 months, we probably would have even seen rates start to give us a little bit of reprieve and those units come up a little bit. But we're already kind of starting the year, pretty much where we were last year. It feels a lot like last year to me.
Yeah. It's also just interesting if we look back historically, like the last time we sold the least amount of homes was 2008 comparative to this timeline. And yet we do have a far larger population throughout the U.S., the economy, specifically here in Utah. I know we sold about 40,000 homes here in Utah last year, but it was 70,000 that we sold in 2008, right? So just some perspective, the challenge is that we have far more demand, but the affordability is a big, big challenge for people right now.
Yeah. You can see it starting just January, February numbers probably are pretty similar. Utah is exactly where we were January, February last year. So again, as we start seeing that rate hopefully move a little bit down, we'll start seeing those closed units come in more. And we'll go over some mortgage data in a little bit.
Home prices, this is interesting too. If you look at the trend line, 2007, really 2004 to 2007 timeline, we ended up getting 21% above the 4% average trend line. Historically, homes appreciated about 4%. And so whenever you get massively above that line, that's a kind of a red flag, right? Now we are actually, if you look at comparison, we're only 7.4% above the trend line. So have any of you heard clients have this idea in their mind that the market's going to crash, right? And they have this expectation of something's coming. But the reality is we're very well positioned if you look at some of the other dynamics, but one of the biggest indicators is that we're not too far off of that trend line.
Yeah, the Great Recession, at one point, we thought we dropped so far below that trend line, we may not recover back up to it. But again, that trend line is pretty dang resilient over the last 50, 60 years that not only we did recover, we are still a little bit above that. And as you see kind of over the next several years, I still think we'll kind of end up journeying a little bit back to right on that line. But again, 423,000 on that medium price. Utah, if we gave that same line, is a little bit higher just because we've kind of become a little bit more of an unaffordable state compared to where we started 20 years ago. But overall, just some solid, consistent appreciation every year. So here's the kind of the core chunks of time, as you can see. Like I mentioned, when I got in, I knew nothing but the Great Recession. There wasn't a seller appointment that I went on that I was not the bearer of bad news, that the home was worth less than they thought it was. I'd always say, "What do you think your home's worth?" They give me a number, and I'd be like, "Oh, you're wrong," every single time, because we're going down, right? So over that 5-ish year period, we averaged negative 4.4% appreciation. So every year, every home got worth a little less. That's kind of been the difference from us as closed units dropped off, but our prices have stayed pretty solid, which I'll tell you is our saving grace and our blessing being in the industry right now. But again, we had a pretty solid decade, of right around that 6%. Had we not had that pandemic and COVID that just sent us totally out of whack, we averaged 12.5 percent appreciation over those 3 years, which is unsustainable. So no doubt over the last couple of years, and I'd probably suggest over the next 2-3 years, it's going to take us a few years of a little bit, more conservative appreciation to kind of just get affordability back in check where we need it to be. Yeah. So
I think it's so important for us to enter the conversations that our clients are already having in their head. And what this kind of shows me, how many of you have had a conversation with a seller to list their home and they have a way higher expectation of what their home's actually worth than what you think it should be priced, right? And so one of this is we have to realize this is probably what's stuck in their mind, right? Is this massive appreciation years where homes were going up 10 to 20%, which is abnormal. That's not the norm. And so we really have to reset expectations and show them the data that yes, homes have still maintained value, but they're not appreciating like they had been the prior years.
Here's the swings, kind of just with the headline, whether you call it the Great Recession, the dot-com boom. Here's just kind of what happened with those significant points of the economy over the last, 50, 60, 70 years. And one of the things they mentioned in the vision speech is employment or unemployment actually tends to follow these. As the real estate economy is kind of going up, you see employment going up. As you start seeing the turn and it going downward, you start seeing more unemployment showing up in our economy. And you'll see that play out even just the last 12 months with the unemployment categories. So market volume, Gary always points out, we are still set this next 12 months, 2026, to have the third best volume year in the history of the United States. Again, because prices didn't go down, prices are held steady. We have a great purchase price out there in the country. We're set up for the third best real estate year ever as far as the volume category goes. We typically get paid not on units, we get paid off on volume, right? So that's definitely a blessing for us. But again, 2020, 2021, just some crazy years there that went up just a little bit. But also you can look at agent count, the overlay of agent count follows the money. As that volume's there, definitely agents, are getting in the business. As volumes start going down, you start seeing agent count go down. So I actually would have projected a little bit more realtor loss in the country, but because that volume's kind of held steady, we haven't seen realtors getting out of the business like I thought they would have, the last year or so.
Well, Johnny, it's interesting. This is the third biggest year in history, right, in sales volume. Why do some people still feel like it's been a challenging market to compete in? Because that shows the money's there, right? But also one of the trends that's interesting is sides per agent, right, which has an impact. And so there's fewer deals to go around per agent, That's the challenge. I think it was at the peak roughly around 9 average sides per agent, and now it's down to about 5.6. So there's less deals to be had per agent. But the top agents are doing more of that production.
Yeah, my recommendation is always still set your real estate goals based on units. Don't let the volume dictate your real estate business, because if you're still driving units and get on the higher end of the 10 sides per agent, that still is a very healthy business. Inventory, this is pretty simple. We've seen that just kind of trickle up as more listings have came on the market. That whole mortgage rate lock-in effect that we've had, we're starting to see a little bit higher percentage of mortgages, upwards in the 5s and 6s as far as percentage of mortgages, which you'll see in a second. But more listings have been coming on. Days on market's been sitting a little bit longer. Still a healthy spot to be in. Again, that 6 months of inventory or days on market usually is what we consider the line of flipping into a seller's market or a buyer's market. Over 6 months is considered a buyer's market. Under 6 months, I would still say 4 to 6 months of inventory is my favorite spot to be in the real estate market. I see a few of our veterans shaking their head too. Mortgage rates, again, this is the perspective category. Who in here has a home that you have a mortgage rate of 4% or lower? Raise your hand. Just spoiled. See, we went through such a phase. I have mine as well. I think I'm a 3.25% on my house, and it kind of just skewed our judgment. But look at that green line. This is the last 50 years of mortgages. The average mortgage rate, the last 30, 50 years of those two lines, 6% from 1990 till now. The average mortgage rate is 6%. So even though just being a little bit above 6, as we start journeying to maybe the 5s, the projection is we'll average out somewhere around 5.9 is what our research department has said. 5.9 for 2026. If we're already starting the year, I think Eric said 6.25 or something, just barely. So again, we might see in the spring, summertime, maybe a little bit reduction in some mortgage rates. The one thing the economy, specifically the mortgage market, hates is what? Volatility. Definitely the last couple months of volatility, just unpredictable, standards as far as just what's going on with the economy definitely has affected that. But even look at the last 50 years, that we've averaged 7.72% mortgage rate. So I think even a 5.75, a 6% in perspective still is a pretty healthy mortgage rate.
So here's something that's interesting. 48% of mortgages have rates 4% or higher. Now, one of the interesting facts, how many homes in America are owned free and clear? Anybody know that percentage roughly? About 40%, right? So that's what this statistic doesn't show. But there's also a significant, about 60% of people who have a rate that is sub 5%, right? So if you look at where rates are today, we don't have a wide gap. The challenge is, again, is expectations, right? Is clients have this expectation of what the 3 to 4 year ago market was providing, which is just different dynamics, and we have to be able to educate them on that.
Well, and a year ago, the percent of rates above 4% was almost 9% lower. So again, we're at 48, almost half mortgages now are at that 4% or above, which again, when you have a gap between your current rate and what the mortgage market rates of 3% are, you're going to be a lot more motivated to stay in your house because the rate difference is so extreme. But again, 4%, if we journey down to 5.9, we're talking, 1.5, 2%. That's where we're going to start seeing a lot of that inventory unlock, and you're going to see a lot more turnover. A lot of people have been staying in their house, 1, 2, 3 years longer than they probably would prefer if just the economics would work out a little bit different.
And I think this is where that conversation too of just like we have to be able to provide solutions, knowing if affordability is the challenge, we have to provide solutions to clients. And so being aware of different loan programs that are out there, I know a lot of ARMs are coming back as well. Even I think, was it Edge? Somebody validate this. Was it 1.9% that they're offering right now? Like just some phenomenal rates when we know the solutions that are out there that we can present to clients.
So affordability is the name of the game, right? As we've just felt things be less affordable. If you look at just the appreciation along that 4% trend line, If we stayed the same mortgage rate over the last 30 years, we would have incrementally felt the cost of that home. One of the things I always say is because we went through that time period of such low rates, even though homes were going up in value, as soon as mortgage rates zipped up, it's almost like we got double punched in the stomach because not only were prices higher, but now we were really feeling the true cost of how much homes have been going up over the last 10, 20 years. We went through that period that the mortgage rates being so low insulated us against the rising costs. So that's why we saw payments almost double in that 1-2 year period of time. But we are rebounding, which is the good news. I've seen twice, some of you that maybe been in the real estate longer, when we get to that historical average the last 25 years, affordability below that, around that 20%. So this is principal and interest percentage of the median income on a median purchase price with a median interest rate. Okay. So 20% would mean out of your household income, your median income, 20% is going to the principal and interest payment of a mortgage of a median purchase price. Okay. So when you get high, like look at the 1981s, when we start seeing 15% mortgage rates, unemployment was higher, incomes were not rising, 50%, almost 50% of someone's income on average was going to their mortgage payment, principal and interest. We went through a couple time periods that it just felt very affordable. At that time period, it didn't. But it's always in like hindsight. Back in 2012, we hit 17%. Anybody buy a home back then or a rental property? Maybe a couple of you. When you look back 5 years, would you wish you would have bought more real estate? For sure, it's always a good time to buy the right piece of real estate. But then again, when we went into those twos, some of you even got 2% mortgage rates, the low threes, 3.5s. That's what just made the 2020 time period so low. The Fed was just pumping so much money in into the economy. It dropped us to another time period of just low affordability. But as soon as rates went up, 2022 went up, but we have started rebounding back to getting that down. So even you start seeing mortgage rates come down, prices not appreciating, too aggressively and staying pretty conservative, we're going to quickly get back to that 50-year historical average of that 27% of your household income going to a principal and interest payment. So the economy here, so those are the 6 main categories. We're going to just kind of fly through these 10 U.S. economy principles. It is very important to understand what the U.S. economy is doing, how it works, because no doubt we are usually reactive of all those things that are happening with the economy. So we'll start out with just GDP. So what's GDP stand for? So this is the makeup of all products and services that our U.S. economy creates and produces. Okay, so normally we want to see that growing every year, which means our economy is growing. If it's shrinking, that's usually bad. Normally 2% a year is kind of the benchmark, 2 to 3%. Last year we were 2.2%. So overall, despite some of the chaos we've experienced the last 2, 3, 4 years, our GDP's been pretty solid. One of the things on the GDP, though, I will mention, you also have to kind of zoom in where that's coming from. And we'll go through some specific industries, but just chip manufacturing, AI, data centers has been a major driver. One of the podcasts Shoni and I listen to frequently is the All In podcast. Any of you listen to that? Fantastic podcast. But they were talking about our government spending has continued to increase, which is not always a good thing, because when the government is the one spending money, that means it's a non-productive piece of the economy. You want the productive components of the economy to be growing. Because again, if the government's spending money, where are they getting their money? It's just coming from the other portion of the economy that has to give it to the government for them to pay. So not only is a chunk of our economy being funded by the government directly, there's also numerous companies that their sole customer is the federal government. Some of the last estimates that we've seen, up to 50% of our entire economy is coming from government money, which is crazy because, again, that's non-productive dollars in our economy, whereas the other half of our economy is actually creating business, creating products, creating services versus just using tax dollars or borrowing money to pay for it. So again, we also have to be growing the productive component of that. And one thing, too, is a lot of these numbers will go back in time and revise them. So when we put our quarter market report together every single quarter, we have to go back and revise all the other quarters because more of the data comes out to make it more relevant. and GDP has gone down just a little bit every time we revise it. Unemployment and employment is usually the numbers that move quite a bit just because it's such a lag to get all the accurate data. So,
and those are really two components that have a big impact on our industry. Like all of these things are, cross contextualized, so it impacts our industry directly. And a lot of that, when there's more government money in the pot, what typically happens is inflation, right? Not just in the cost of goods, but also in the cost of homes, right? So that directly impacts it. Unemployment, this is something that is trended or is likely to trend up. What are some things that are going to impact this over the next couple of years, right? If we look at just the world and where we're going, one of the big factors for this is not only the cost of having employees, but also AI, right? AI is having a massive impact. And I saw this chart recently of the industries that are most likely to be impacted by artificial intelligence. And it's the ones that you wouldn't have thought, right? It is the really strategic and white collar jobs that are being impacted, but unemployment is directly going to have an impact on overall home sales as well this year.
Yeah, just generally, you don't want this to go up, right? More unemployment is usually a no-no. This is probably the hottest button for a federal government is always monitoring unemployment and employment, keeping that at a healthy number. I do think this is probably even underestimated a little bit, but just unemployment, trickling up. Every 0.1%, we're talking about hundreds of thousands of people in our economy that are now out of work. And typically when they're out of work, that's where the social programs coming from the government have to then, come in and tend to support them. So low unemployment tends to be good.
4 to 5% is pretty healthy. Once you start getting above 5, that's when we get a little worried. 6% is like they're sounding the alarms. That's really bad to be in that 6+% unemployment range.
Yeah. Eric, you're fired. There you go.
Yeah.
Oh, okay. Good.
That's one of the correlations, right? As unemployment increases, they end up lowering rates.
Yeah, they throw gasoline on the economy as soon as they start seeing unemployment up, and that's traditionally comes from mortgage real estate industries. Those are the economic drivers that get us out of rough economies typically. Here's just an overlay of unemployed people on a monthly basis, specific Januaries. And then the orange or yellow line, that is job openings. So if you remember COVID, it feels like forever. COVID was virtually 7 years ago. It started in the end of 2019. It feels still shorter than there. But again, when all of a sudden everything just got locked down, hospitality, retail, just like everything just immediately start cutting jobs, we spiked incredibly up there. Luckily, a lot of even what the government did, a lot of that ended up being initially positive for us, getting unemployment down. But if you remember coming out of that, look at that like 2021, 2022 phase. If you remember going anywhere, there was, job wanted or seeking, new employee signs everywhere. I remember going to every gas station, restaurant, hotel, all of them were just seeking more employees. And we just had a tremendous amount of openings out there. We've crossed now. There's now more unemployed people than there are jobs out there available. So usually when that crosses, tends to be a little bit of a negative sign too. You always want more jobs than the unemployed people. Job growth, this is just the quantity of jobs created every single year. So the latest number, which I think they've already revised this down since we went to family reunion, but total last year, our economy only created 181,000 jobs. I think they've actually already reduced that by another $40,000 people. So again, our entire economy, we only created probably around 130,000 jobs all last year. And part of that is because you're starting to see quite a bit of AI spending in companies, people spending more money in AI, whether it's working or not for them, they're devoting employment resources to technology resources that kind of just stopped the creation of jobs. But the categories, this was fascinating. Shoni and I had a conversation after this, but look at the purple. If you can look at the purple, this is the 10-year average in those industries of job creations per year. So if you look at the bottom, every year on average in the trade, transportation, utility categories, we normally create 189,000 jobs every single year on a 10-year average. Last year, we lost 202,000. Why would that be? Self-driving, could be in there. Utilities could be more automated. We lost jobs where we usually create jobs. Look at government. That's probably a good one. 186,000 lost. Normally we create 127,000. You look at healthcare and social assistance. That was the second only category, which is the major one, that we created more jobs last year than we normally do on average. We created 781,000. Normally we create 482. Healthcare, is anybody's health insurance gone up? Maybe that's why they have more money. But then social assistance could be some of those social programs out there too, which might not be the best sign.
Yeah, Johnny, I think when we were in Canada last year at the Platinum Finance event, one of the things that they talked about, and I don't know if this is impacting the numbers yet, but I know it's potentially coming, is just that the productivity age challenge that we're going to have, where there's a lot of baby boomers who are retiring and there's not enough millennials who are replacing, right, that large generation. And that's going to become more of a challenge as we go on, because millennials are having less kids, right, than the previous generation. So I know that's going to be an impact as well. But I'm curious to know if that is part of what's trickling into the environment already.
So wealth and income, just two quick charts on just wealth growth by income level. So you got top 1%, the next 9%, the next 40%, and then the bottom 50% are the different lines. Pretty much, up until the early 2000s, all four of those categories were growing in the same kind of percentage basis. But then it just kind of took off from there. You see that top 1%, their wealth has grown 1,076%, whereas even the bottom 50%, you look at post-recession, even went negative for a time period and then has increased. And then the next slide is just the income growth, which is even a more clear separation. Click on the next one. This is the income growth. So this is their income versus their wealth. Income growth, look at that separation of upper income versus middle versus lower. We were pretty close together, early 80s, and just a lot of those big, economy swings. But this is also a testament to time value of money. Yeah. When you have some assets over time, that time value of money, that compound interest calculator just really is in the benefit of people that acquire assets.
Yeah, and I think this is, part of this too is like just an indicator. It's more of a reminder of why we need to be such advocates of people buying homes, especially first-time home buyers, because a lot of this wealth comes from real estate, right? Even at last year, 2% growth here in Utah on a $500,000 home that they might own, their wealth has grown by 10,000, right? And so that's one of the components that's missing for a lot of people, is they don't have assets that grow in value when inflation occurs. Adam? Yeah, part of the code of ethics.
Yeah. This was fantastic. I'm glad they did this. This is wealth and income. This is age 30 of the different generations. So when baby boomers, millennials, Gen X, when they were at 30, this is inflation weighted. So this is taking inflation out, weighting inflation into it. So these are very comparable numbers. The average baby boomer at 30 years old, on the far right, you can see their median net worth at 30, baby boomers, $24,900. At 30, the average millennial median net worth, $36,000. It's crazy because this was almost flip-flop opposite in my mindset from what I've been trained from the news media. I want to blame the baby boomers for screwing up everything for me as a millennial on why I'm not as far ahead at my age as they were. But this is the exact opposite. The health financially by 30 of those different generations, millennial is doing the best, surprisingly. And again, this is inflation weighted, so these are very apples to apples comparison. Total assets on the left, average total assets, the average baby boomer at 30, 147,000, millennial, 219,000. Interesting. Why do you think that is, Shoni?
I think part of it is, again, just like it's context, right? And I think a lot of it is the conversations that we have with people. One of the challenges is there more ways to be bombarded by news today than there was 20 years ago? Absolutely, right? And so headlines, again, going back to that initial thing I mentioned, headlines are engineered to capture attention, which typically has to spark fear, right? And what we have to do is kind of be the grounded source of saying, actually, we're kind of in the best, even when it comes to people pointing out like a lot of the crazy stuff that happens in the world, we're still in the safest time in history, statistically, right? But when it comes to the numbers, we just have to put this into perspective that like we're actually doing pretty dang well. And we have to remind people and also help provide them with solutions. That's the biggest thing that they're asking us for right now is I want to be able to make a move or a transition, but I need somebody to guide me on the how. And I think that's our role.
And it's just economic spending habits, like just like the ease at spending. I click, boom, I bought a whole bunch of stuff on Amazon, right? But then also social media dictates the life that we should be living in a lot of ways. So I think part of that is we're just distracted and our money is getting spread out more versus having clear priorities of put a down payment on a house or whatever. Dean, did you have a comment?
Yeah, I was just going to say too, if you think about just our industry, if you're buying a house and we're spending crazy money for houses and all that, well, 10, 15 years ago, I spent absolute top dollar for a house. It more than doubled in that time. So even those houses that are going crazy today, over time, if they're going up 2 or 3%, you're still gonna, geometrically grow your net worth.
Yeah, I agree.
That's where we just have to show the real story. I even when 2016 I bought my first rental in Draper. It was a townhouse for $225,000. I thought I was overpaying for it, right? And so it's just like we have to tell that story and remind them over time values of real estate is going to increase, right? Yeah.
Again, perspective. Like we have to be looking at perspective. Inflation, this, we talked a lot about this, but we've been moving inflation back to where it belongs. We ended the year somewhere around 2.7, 2.5, depending on which inflation you're tracking. But then really the target and projection is 2026, getting it back down to that 2%. 2%. The Fed, this makes the news all the time. Poor Jerome Powell, whether you love him or not, he's got the target on his back. But again, Jerome Powell single-handedly does not make all the decisions for the Federal Reserve. This is just a quick slide to help educate people how the Fed actually works. It is a majority vote of a board of 12 Fed governors basically that make the decision. So it's always majority vote led, even though Jerome, being the person that has to do the news briefings and stuff, usually it appears differently. The way that a Fed is made up is clear. You have a chair, you have a president of the United States appointed board, the 7 that are appointed by them. They run for 14-year terms traditionally. The New York Fed president sits on that board, and then the other 4 local Fed reserves around the country sit on that. So it's a committee of 12. Yeah. So again, even his replacement is not going to be a dramatic thing. It's just going to be one other vote amongst those 12 people. Mortgage rates, Fed policy, again, that Fed funds rate that the Fed dictates, we always try to say it's not directly correlated, but it ends up being correlated to some degree. So you can kind of just see the blue line is the Fed funds rate, and then mortgage rates, a lot more volatility in mortgage rates, but still generally kind of trends a little bit towards those rates. As you saw, just the Fed rate, we've dropped 1.2%. Mortgage rates has only dropped 0.1%, right? Which is a lot to do with the volatility, the risk premium, that type of stuff. A little bit more accurate, which our mortgage Aries and the A team talk a lot more about is the 10-year Treasury. So the 10-year Treasury is the blue line, and then the mortgage is the yellow on top of that, way more closely aligned. So if you're not paying attention to the 10-year Treasury, that should be one of those things that you look at often. And then usually the gap tends to be either the revenue to mortgage companies or the risk or the future predictability of the mortgage market kind of tends to be why those gaps are either bigger or shorter on the way that loans are priced compared to that 10-year Treasury.
Consumer sentiment, and this is just how do consumers actually feel about the market? And one of the interesting things, if you look back to 80, well, actually, I don't think they have this one on here. There's a slide where Gary was just talking about in 81, right, when they had 17, 18% interest rates, consumers actually felt better about that market than they do today at our current interest rates of 6.5%, 7%.
I think it's the next one.
Right? Is the next one that show it?
Yeah.
Yeah. Yeah. So this goes right here. So 20% was the consumer sentiment back in 1981. We're at 17% consumer sentiment now. So people feel far more negative about today's market. Now, who's that a reflection on?
The information they're receiving. Yeah, absolutely.
Totally. Right. When they see a lot of bad things from the news and the media or social media, they end up having some sort of belief, right, about the market. And so we just have to empower them with data and show them the reality of our current environment.
So just some economic risks. These are the things that could affect the future of our real estate industry, mortgage rates, is policy volatility, weakening labor market, AI market correction, inflation, geopolitical conflict. We'll hurry and hit each one of these real quick. Policy volatility, if you want to hit the next one. Tariffs, right? We know tariffs have had a little bit of effect for sure on inflation. Effective tariff rates rose from 2% to 25%, then fell to 17% in 25. A lot of volatility with that. 2 government shutdowns. We still have a continuation of those. You hear it mostly in TSAs right now. Radical changes. We don't like radical changes. Every administration will either tighten or loosen specific guidelines, but just the speed, the radicalness is usually have an effect. All adds up to just a difficult planning environment for just the economy. Go ahead.
Weakening labor market. And this is where, again, this has a direct impact on our space, right? And so hiring has slowed across the economy with exception of healthcare. AI is likely slowing hiring due to efficiency gains in cognitive work. Obviously, that's going to be the continuous story, I think, over the next 3 to 5 years. Even more so, we're going to have impacts in the employment market based on AI. The company's shifting spending to AI and away from other core businesses lines may impact hiring and layoffs, and then high interest rates reduce business investment and slow hiring. So all of those things are components that are impacting available jobs.
Yeah, AI, you're starting to see a lot more news articles talking about just all the money that's gone into AI. Was that the right thing? Just a lot of the capital expenditures. There's over 394 billion invested. Even the math on probability of data centers, are they actually going to pencil, now that we've poured so much money into them? Investment highly concentrated with a few companies. Just the big tech companies that have had just the power, the money, are playing a little bit of an unfair game right now. Inflation again, tariffs again, who knows what's going to happen exactly with tariffs. I feel like every day is a little bit different news article, but tariffs have put upward pressure on inflation. It could be temporary, it could not. Upward movement in prices, could result in interest rates being a little stickier than we want.
And then just conflict, right? This always sparks uncertainty, and uncertainty. The market doesn't love uncertainty. Your clients also, their decision making is based on a lot of the certainty and uncertainty that they feel in their life. And so a lot of this has a direct impact. So active military engagement in Middle East, obviously the stuff that's going on in Ukraine, now Iran as well, diplomatic tensions with traditional allies, all of these things impact trade and income for the U.S. as well.
We just need to get along, okay? Can we all just get along in the world? Just skip this one. Skip these Canada ones. A couple U.S. events. So let's try and fly through a couple of these just so you're aware of them. Sites per agent we already mentioned, but you can see just early 2000s, it went from 13.5 down to 7.5 sites. It's just more people were jumping in, chasing the dollar. You saw the sides go down. I was there in the recession where we went up. Even in Utah, I think we got to like 10 and a half, 11 sides, something like that per agent. But again, prices were fairly low back then. We've seen that backdrop 9.8 to 5.4 as you get more units. I don't think we're going to have a flood of agents get in. We could see maybe there's usually a 2-year lag. When the market starts going down, people get out 2 years later. I would predict that we start going up now in sides per agent. Hopefully we start seeing the 6s, maybe even the 7s would be my hope. Sides per agent.
Just to double tap on what you said earlier, Johnny, this is where it's so important to focus on setting goals based on unit count, not on volume. Because volume can mask some of the lack of our own productivity because it makes us look good, right? But the challenge is over time, you start to diminish your actual GCI, your actual returns, if you only focus on sold volume. We need to really focus on units.
Volume we talked about, but again, third best year for volume. Takes you back. But again, the only difference that I put in caveat here is just, again, what the income, we got a little bit less spending power now than we did 10 years at 3 million or 20 years at 3 million. Listings with price drops, 22% of listings with at least one price drop. You can kind of see just over the last several months how that's changed. New listings, again, here's every single month. So the season, you start seeing that seasonality, more listings coming on the market. Each month almost outpaced the year before. But again, 5.4 million homes came on the market last year, 4.8 in 2024. Projections are going to be a little bit more. I think in 2026, more listings will come on the market by 5-10%.
Yeah. And that's probably too a big one where people are taking more listings, and one of the focus points is we need to have a strategy for selling the listings, right? So homes are sitting for longer on the market. And so it's really time to double down on what is my marketing strategy that effectively gets homes sold. Right?
Distress sales, still a little blip on the radar. We're starting to see a little bit of an increase of these distress sales. Traditionally, less than 1%. We're up to 2% the last couple of years. Still nothing like the post Great Recession of, like it said right there, short sales and foreclosures. 2008, over 40% of our market were distress sales. We're starting to see a little bit more because appreciation has slowed. So again, usually it's just the cost of a transaction, title fees, agent fees, that type of thing. But when they buy, the home only goes up 1 or 2%. Sometimes those fees can put them in a short type of situation, but still tends to be a very small piece of our market, but worth paying attention to. Underwater homes, crazy back in 2010, quarter three, 24% of homes were underwater. Pretty much anybody that's owned a home, 4 years, 5 years, very difficult to be underwater. But again, just the 1 year purchase people that are wanting to sell or something has trickled up a little bit, up to 2.3%. Credit loosening. We're in a loosening phase. Even Trump just keeps signing executive orders that have to do with the real estate market. He signed 2 more this morning, if you want to watch that, about loosening some local bank and community mortgage guidelines, another one. But again, tends to be a little bit more of a loosening time period right now.
Yeah, and I'll even speak to this one here in Utah. This is one of the challenges for us, is we are underbuilt, right? We had almost call it the lost decade, a whole timeline where we did not keep up with the demand. And that's the challenge that we're in right now, is we have obviously a lot of great builders out in the marketplace, but they have not kept up. We're probably 30 to 50,000 homes short of where we should be in the market.
Yeah, and the second executive order this morning was just loosening some efficiency green requirements that could potentially lower costs for builders. They're trying to get more homes built. You could pay attention to that one as well. But again, normally we want to be at about 1 million homes started every year. Next one, go ahead. Student loan debt, we know that's gone up. We've 300%. We've gone up 300% in student loan debt since 2005, the last 20 years, whereas all the other debt, we've gone up about 75%. I know our mortgage professionals say that student loans and that payment is definitely affecting debt to income. Either way, debt bad, no debt good. Homeowners insurance. A lot of you, especially if you own rentals, I've seen almost every one of my policies go up the last several years. So this is an actual stat that you can track that. We went through a good 9, 10, 11-year period there for a bit that we stayed at a 2.2% average increase in homeowners insurance. But then look what happened post-COVID that could be related, not related, but went up 11.4% in 1 year, October 2024. A lot of you felt that. And a lot of the reasoning behind that was an extraordinary year of natural disasters. We saw more floods, more fires, earthquakes, that type of stuff. It has decreased, which is the positive news, there to 6%. But again, we got to get that back down to 2%. And this isn't your homeowner's insurance getting cheaper. It's just saying now it's only going up 6% instead of 11%. So getting that back down to 2% is a lot more sustainable on our insurance policies.
And Johnny, I know you used to be in the insurance space, and I didn't know this until recently that they group kind of states into regions, right? So even if something happens, natural disaster in other states around us, that also impacts insurance rates here in Utah, even if it didn't happen.
Yeah, like the California wildfires affect our homeowners policies here. Yep. Generational wealth transfer. If you look at that baby boomer, Dean and all of his friends, they control $85 trillion in assets. If you want to be named in his trust or will, go ahead and take him to lunch today, this week, whatever. 85 trillion. So the baby boomers control 50% of all assets in the US. 19 trillion of that is in real estate assets. So this is just a survey of people over 55. 73% of people say they want to give all or some of their estate to their children before they die, whereas 30% on average want to give away 30% while still alive. So again, not waiting until baby boomers have already passed to help solve some of those family issues. You should be helping solve their generational wealth transfer, be their wealth advisor. There's even a community in KW that has some specialized training around that. But again, getting some of those assets moved down to their kids, grandkids is definitely happening at a increased rate over the next several years.
And I even think this is an important kind of just mental note to take, is asking yourself, am I actually lead generating to serve and support these individuals? Like, do I have anything that's out there showing that I have a solution for them? For example, do I have a, maybe a legacy estate planning checklist, right, that they can download, and it helps them to plan on passing that wealth on to their next generation, right? So start putting some things out there that can serve people in that category.
I just want to hit a couple of these luxury and commercial slides, but just hit this one. Again, it just shows the wealth, high net worth individual. We've went from 10 million high net worth, that's a million net worth or greater. We went from 10 million of those in the world. We're now 23 million millionaires in the world. But go to the next one. This is basically where the allocation of financial investments are. You can kind of see the trends of where their wealth is located. The bottom one, we've stayed pretty consistent, but the last 2 years, we've seen a bump up in real estate. So the last 2 years, we went from 15 to 18 and 19% of their wealth being held in real estate. So more purchases have happened. Go to the next one.
I think it's just interesting, Johnny, because the wealthy look at real estate as a safe asset, right? So they're moving their money from more risky assets into real estate.
Yep, I agree with that. Yep. Luxury days on market. Luxury days on market are always higher. So there are 86 days as of December, 86 days compared to 62. And then the next one, there's less price drops in luxury. So you can see 13% with a price drop in the luxury world. So not only do they stay longer, they also hold more concrete to their price, maybe because they can just sustain a listing sitting longer. And then commercial, just want to hit these trends real quick. These are just commercial trends for any of you that are selling commercial real estate, kind of just what's been going on in a lot of these asset classes. I felt this a lot personally too. Office vacancy hit a record of 20%, 20.5% office vacancy out there. Asking rents finally went up a little bit, 1.9%. It's the strongest growth since the pandemic. Just a lot of office space has to do with, is the economy growing or not? Are they adding jobs, that type of thing, just because that's where they got to put workers, as in offices traditionally. The flight to quality continues. People are upgrading, going from B and C class to A still, even as A's experience vacancies and prices have maybe dropped a little bit. Office delinquencies climbed to 12.3%, highest since 2000. You've been reading some headlines about this, but a lot of this is commercial loans are not like 30-year fixed rate loans. All my commercial assets are 5-year terms. So I have to requalify and get a new commercial loan every 5 years. A lot of those loans that I got in 2021, 2020 with low rates, I'm now having to get a new one with a 1-2% higher rate. And all of those economics now have to work out with the same rent, with the same tenants. So you're starting to see people, just because of that rate bump up that they're now feeling, you're starting to see delinquencies happen. And I don't really see this going down in the near future. I think the next 12 months, it's either going to stay there, maybe go up a little bit. Retail continues shifting to mixed use and just experience-led formats. You even look at all the malls and the big developments, more experience-led mixed-use developments still in the retail. Vacancy held right around that 10%. Multifamily rents fell another 1%. So we've seen rents stay or even go backwards in a lot of the multifamily, mainly due to the surplus in multifamily. Vacancy hovered around 6.3%. Even the luxury apartments, you see a lot of this in downtown Salt Lake, a little bit overbuilt in the luxury multifamily category. Their vacancies haven't been great. Their rent growth hasn't been great. And then even industrial, construction spending cooled 5%. That CHIPS Act they passed passed forever ago that funded a lot of that. You're starting to see a lot of those projects wrap up now, which is why you're seeing that cool. And again, just more flight to that Class A leasing space. Vacancies ticked up to 7% in the industrial world, and then rent growth flat, basically. Multifamily units started. You just saw those couple years above that trend line. So we kind of were anticipating a more growth. We're finally almost absorbed a lot of that multifamily. I watched that quite a bit in Utah. But again, we just kind of overbuilt for a couple years. It just took a little bit longer for us to absorb. And the next one, loan delinquency. Like I said, you're going to see this probably go up, I'm guessing, would be my projection out there. And then the last one, industry news. Again, just pay attention to these big topics. You saw the Compass Anywhere merger. That's still getting worked out right now. The Redfin acquisition. You're seeing this private listing, public listing battle. Dean's trying to keep you guys up to date on a lot of that. Even the CoStar, Homes.com, CoStar bought Homes.com, and they've spent a tremendous amount of money trying to get into the residential real estate with them being a commercial company. And you're starting to see shareholders of CoStar starting to complain now, quit spending our money. We want that money back type of stuff. So
Yeah. Even one that's not on here, I assume they didn't want to announce it yet, but we were just on a meeting today, and I know we'll work out the details and have more conversations around it, but you'll just see some of the news around Zillow and KW's, strategic alignment. And I think this is all kind of a response to some of the other stuff that's going on in the industry. And so we'll be talking a little bit more about that, but you'll see some news headlines coming out today, really about.
Yeah, we probably should read them. Gary's written a couple op-eds, just really what our stance as a company are. There's been more volatility with the way that we treat listings the last couple of years than there has been the last 30 years. And part of that is how we view private listings versus, throwing it out to the whole market. And then the second one is just coming soon. So before it's actually live, what is the coming soon? And that's just two big cans of worms that we'll have to open up at another meeting. But Dean's staying up to date on a lot of that, and we'll make sure that you got all the info we get.
Yeah, just on point number 4 over here, where you see CoStar and Homes. Homes.com was celebrating when they hit 100 million eyeballs a month. And Zillow's got over 220 or so million a month.
Mm-hmm.
Right now, Homes is down to 34 plus
Really?
a month. So they've really dropped off, but their spending has dropped off, dramatically as well.
Yeah. Yeah. Cool. Okay. All right. Thanks for hanging in there. Any specific questions that you want to throw out before we close? Was it helpful? Yes. Okay. Do you have a question?
Harry?
Solo agent meeting in the small training room after this. Sally.
Like value add when we're reaching out and doing like our employee calls or like whatever, like where would you say, like what strategy?
So I try to make this as easy as possible for our agents to look at the national numbers and compare them to the Utah numbers. So every quarter, if you haven't watched any of them, even if you think I'm boring and you don't want to watch it, at least look at the slides that we put out. They're on kwutah.com, find the slides, and it jumps back and forth between Utah and national and all of these. It is a lot of data, so you kind of have to be very specific on which slides are the most useful for your seller or your buyer when you're having a pricing conversation. Days on market going up, more listings coming on, more competition. Like showing them some of those data is very important. But I think having some of the most important data points in your buyer and seller presentation is very important. And then when it comes to your 36 touch program that is going out to your sphere of influence, I really don't know why every email that goes out shouldn't have some sort of highlight of a relevant market statistic. And then the second would be your social media posts. You don't want to bore everybody, but like if all you're posting is recipes and not market data, you might be missing on a big opportunity to educating your clients. The number one thing that buyers and sellers want from their agent is not only fast response time, but it's usually a look at what's going on in the real estate market and how it relates to their own personal transactions.
Yeah. I'd even add to that of like share the success stories of clients that you've helped the last 12 months. Like there's probably clients that you've served who they were challenged by affordability or they felt like it was just unaffordable, unreasonable to buy right now. And then you help them navigate getting a great deal through new construction, or you help them to secure, an assumable loan or something like that. And so find those stories and don't hide from the data. Like show them some of the slides. Don't, you don't have to go through all of these, but show 2 or 3 slides that say, look, affordability is in a challenging spot. It's definitely not as bad as it was back then, but there's 3 different ways that you can win in this market. And here's some solutions that can be helpful. And so that's what I'd start, kind of replace fear with facts, right? Show them the reality.
Cool. Anybody else? Okay. Anything else? Final announcements?
Becca here still? Next Tuesday.
Yeah.
Events, and you and Susie are going to be talking about events, right? So just be here for next Tuesday, 11 a.m. We're going to show you how to master and get more listings and buyers through client events. So be here.
Cool. That's it. Thanks for coming, everybody.